There's a pair of restaurants in Minnesota where your sushi order may have officially never happened, even if you have a receipt and an Instagram post to prove it. According to the Minnesota Department of Revenue, these two restaurants erased more than $3 million in sales over a 15-month period, costing the state $240,000 in taxes. This scheme sounds like a case for TV's Food Detectives, but it's serious business. States and the IRS lose about $30 billion annually because of it. The main way businesses skim this money, and the way the Minnesota sushi restaurants did it, is with something called a Zapper. No, not that kind of Zapper. These Zappers are actually software that merchants can install on their POS or point-of-sale device, such as a cash register or card reader. This software erases, or zaps, some of their transactions. We asked Richard Ainsworth, who teaches tax law at 2 law schools and is an authority on tax zappers, to walk us through how it works. Step 1, obtain the Zapper.
It's going to be sold to you by the person who sold you the POS system itself.
In the past, merchants have used a memory stick or CD drive to install the Zapper onto their point-of-sale system. But in recent years, things have gone high-tech.
You can get what we call phantomware, which is a pre-installed program inside of the POS system that's done at the manufacturer's level.
Step 2, program the Zapper.
Pre-select the things that you're going to eliminate.
For example, you may choose to zap all tuna maki roll sales.
So it goes in, it eliminates what you want it to eliminate, and it'll recalculate the tax, and then it will re-index all of the receipts. So everything looks normal, all of the orders are in line, all of the items that you sold are correct, all of the tax calculations are correct.
Voila! No tuna maki roll sales this day. Step 3, hide the evidence.
Now you're going to have more money, so your bank deposit has to match what the Zapper told you collected during the day, and the rest of it you've got to find something else to do with.
Then there's another problem.
But you've also sold less inventory of certain types of things.
So when the auditor asks what happened to all that missing tuna, oops, it went bad and had to be thrown out. For their part, states are well aware of the issue. Out of the 45 states that have a sales tax, 31 have banned the use of Zappers. But enforcing the law isn't easy. An auditor may have to visit a restaurant multiple times before they even suspect a Zapper is being used. And then a tech specialist is required to find the software, a process that can be expensive. So, what's the solution? Some governments are getting creative. In Quebec, officials made a sort of reverse Zapper. Instead of zapping receipts, it records them, a monitoring device that cannot be tampered with. Businesses must attach these devices to their POS systems by law. In 8 years, Quebec collected an additional $2.1 billion in tax revenue. So, why don't we do this in the US? The main objection is privacy, but Ainsworth says that concern is overblown.
Is it appropriate for the Department of Revenue to get real-time data from me running my restaurant? Yes, it is, because we have the right to audit every sale that happened in your restaurant. We just want it now, before you have the opportunity to manipulate it.
Now, if there were only a way to zap your ex out of that sushi Instagram post.